March Madness is actually already started, even though my bracket is likely to be busted by, Friday. My name is J.O. Welcome to Jay's Corner. It is Sunday, March 16th, 10 a.m. Eastern Time. We're going to go through some of the changes that have already grabbed the headlines, effect on you, and also some market comments as well as what I've actually already seen on YouTube and tell you what you need to look out for. All right. So let's just get started here. This is the Substack, my newsletter, Jay's Corner, jo.substack.com. And I've got a special offer here today, and here I'm going to show it to you. If you buy my book, I am the author of Maximize Your Medicare. If you type my name, J.O. Medicare, in Google search, whatever web search engine you use, you'll see only about 300 quotes plus in the national media when I've made certain comments about specific Medicare healthcare cost planning issues. The point here is everyone's financial plan, doesn't matter who you are, doesn't matter your age. I always start with a simple question, is how much money is it going to cost? Medicare, health insurance, the biggest number in there that I'm trying to help people all the time nationwide, irrespective of your age division or your net worth. Okay. If you buy the book, you send me an email, info@gh2benefits.com. Say, Jay, I bought the book. I'm going to give you a year's subscription to the paid version here. And part of the reason for that is that the number of topics that we've talked about in this channel is basically too long to mention. So many different topics, almost unrealistic that you could just scroll through here and get every topic. You get access to the archives. So go to maximizeyourmedicare.com or find my book on there in the lower left. Buy it. Send me an email. Say, Jay, I bought your book. And I will turn on your paid subscription to the paid subscription here. Be sure to check out other videos on the channel. Most recently, this past week, I released the 1-hour conversation with Robert Powell. Basically, Bob is published in every popular national journal. Wall Street Journal, Market Watch, USA Today. It simply is not going to matter. You will find Bob Powell's name. Basically, when I talk to other financial people, I basically say, well, everyone loves Bob. And he is as nice a person in person as a person as he is well intended. He's an OG of my work for over a decade. Okay. That's Bob did not pay me to say this. All right. So that's it here. We are, still here in Doge. So if you go in social media, you will see lots and lots and lots of stories about federal employees, temporary employees, court cases, etc., etc. This is, I think, at the minimum, very unsettling to the people. Okay. And again, you're not here to get my political or philosophical view. I'm simply not about that. Nothing about me is about that, to be candid with you. I am not here to tell you whether or not I think it's right or wrong. I am telling you that you can be affected. Money is complicated. There's a ton of jargon. And I'm going to, of course, do my work as I'm highly regulated. But importantly here, I'm not your philosopher. Politics unwelcome. I'm not trying to create the world some type of utopia. I'm trying to help everyday people from every walk of life, irrespective of your location or any of your philosophy or politics, about dealing with the world we have, not the world we hope for. You have to plan for the world that we have, given the facts as stated. And I'm trying to bring you clarity on that without philosophy or politics involved. Simply unwelcome when you're trying to think clearly. They will create a behavioral bias and decision making gets blurred. The world is already blurry. We don't need these extra ingredients here to make it even more cloudy. As always here, part of the unsettling thing here is going to be you've got government cuts in grants and programs. You can see them. Johns Hopkins laid off thousands. The question is, how are you going to replace? How are you going to replace the money that the government going to stop spending or purportedly going to stop spending? And that I simply do not have the answer. And neither do you. The point here is we don't know the speed. We don't know the speed. Let's just say, for example, you took all of a sudden, you took a pay cut of $100 a week. Well, you need to get this $100 back. There's going to be time lapse for you to get a job in order to replace the 100. Maybe you need to get a gig. My point is if you, on a macro level, you don't know, we don't know. The same things can be here for tariffs. And I'm not debating. I've already discussed it. I should probably call this video, all my videos and Jay's Corner to be, we've already discussed this. Meaning that other episodes here have discussed the point that tariffs do have a reason. I can understand the rationale. That said, tariffs are regressive. And by regressive, what I mean is that they are a tax and they're going to hurt the people who can afford it least. If I increase the price of an avocado by $2, that $2, if you have $20 million, doesn't matter. To the person who lives check to check, who waits for their paycheck to be cashed, that $2 increase is a lot. They don't have the time to replace this stuff, these extra costs. And this is what I'm trying to help people and why I'm trying to, therefore, in other walks of life, push down their costs as aggressively within your situation. Back here to Doge. So my concerns, my issues here are now here. For example, Medicaid. I don't think there's any question. This is the first issue that's going to be on the block. Right? We had this one. We've had this. If we look online, you will see it. That the question here is that here it is. Social Security, for example, Social Security, Medicare, Medicaid. These are the largest uses of the federal budget. Elon Musk over the past week. Time goes so many events every single day. Can't even remember. But he's online saying, hey, these are the big ones. These are the big ones. And that is the cause of some alarm. We, again, don't know the speed. You can keep up to date here. Jay's Corner, we're going to have it blow by blow and the effect that it can have on people. You can see, for example, just as a microcosm, just as a single example, what's happening in Washington, D.C. And I brought this up here. This is Twitter, X. And this is a high quality information channel, I guess, if you will. But this gives you an idea about what's going on in Washington, D.C. on the increase in unemployment in the greater Washington, D.C. area. And also, as a result, how many more homes, nearly 5,000 homes listed for sale since November 2024. And you can see it here. And I'm not going to verify every fact. We don't have to be right to the 10th of a percent. Lowest since January 2020. And now, and this here is that going to show you some shocking things, because this has created the fact that government employees not traveling to their work to other parts of the country. And you can see what the market has voted. The market has voted here. So Washington D.C. very highly hit here by Doge, and so are other people. And we're going to go right here to one of the largest segments, which is Veterans Administration and the federal employees. So complicated is what I would say. Let's first talk about veterans. So as you can see by the lower left underneath the text and is the cover of Maximize Your Medicare. VA is very, very complicated. And you can see here that, let me just see if we can get it. va.gov is their website, right? If you're a veteran, you already know this. va.gov is your website here. The issue here, and this has always been the case, is that if you have VA, okay, then you can switch to Medicare or not. You can have them both. You can have both Medicare and VA simultaneously. Even the VA here, you can see here that sometimes people, or sometimes even the VA here is saying, is telling you that you should still sign up for Medicare. So Part A, not in today's video, right? 0 premium for most, unless you don't have the required number of quarters of coverage. Otherwise, Part A is 0. But you can also see the fact that even VA is telling you, should I still sign up for when I turn 65? And you can see here, this has always been here. They've been consistent. This is before the new administration took office, right? This same stuff here. And this becomes the issue here. And you can see here is that if you delay signing up for Part B, then you'll pay a penalty. Now we're getting into cost and the concerns here for lowering benefits, which is the period that you can sign up for Part B ends on March 31st. Okay? You can sign up for Medicare Part B prior to March 31st. Your Medicare Part B will begin on April 1st. If you decide to pass, you have to wait to Q1 of next year, January of 2026, and then it'll start the first day of the month after you sign up. So those days means only 2 weeks away here, only 2 weeks away, which is if you're a veteran and you are eligible for Medicare and you've been waiting, or if you've turned 65, for example. So this one is specifically to if you're turning 65. If you're turning 65, you can sign up, and then if you do not, you'll have the Part B late enrollment penalty or a delay in the implementation of Part B, one of the two. If you are already Medicare eligible, you can still sign up. That window closes on March 31st. It is throughout Q1, January, February, March of every year. Now, if you don't have Part D, which is the prescription drug portion, many veterans use VA drug. You do not have a late enrollment penalty for Part D. So I'm not going to, it depends on your situation, etc. I'm just going to reveal to you many people what happens. Look, I get my medications from VA. That is totally understandable. They negotiate the drug prices separately from Medicare. The money comes from separate sources, VA versus Medicare. So as a result, the negotiating power for drug prices is separate. This explains why in the past you've had VA cost, out-of-pocket cost, possibly be lower than under Medicare. If you cannot right now, you cannot sign up for Part D today. So it's crazy. Crazy people write books, right? Don't write a book, right? But crazy people write books about the nuances here. There are specific enrollment windows. The rules are in your favor if you understand the rules. MaximizeYourMedicare.com is there. My book is there. Here's the website for my book, MaximizeYourMedicare.com. Complicated stuff for even on veterans straight out of the block. You can see on social media lots of stories about delays. The entitlement card, the card that the VA employees is now down to $1. So basically they don't get reimbursed for any travel to different types of work. So that is the first group. And the second one is FEHB, which is federal employees. Now, I'm not here again to settle the crossfire or court cases. Temporary, permanent, reduction in force, I guess, RIF, I guess is a term. I'm also not an employment attorney. That said, what happens here is if it seems to be the case, and you need to confirm this with the HR personnel there in your specific area. If you are laid off from federal government, you have temporary continuation of coverage, which is slightly different than COBRA. Okay, so COBRA is the federal law, which, for example, if you work for a publicly held company, a large employer, then what you have is, anyway, this is back to OPM, but this is the federal government, which is temporary continuation of coverage. You have 31 days, basically. You have 31 days for zero. I tell people, look, get as much information about your situation as soon as possible on this particular topic, and then figure out what your options are. That doesn't mean that you initially just sign up for continuation of coverage beyond the 31 days. Find out your options first. I tell people, clients, you're here early. I'm glad. Let's do all the preparation work and flip over all the pebbles on the beach as aggressively early so that you aren't stressed out because maybe you forgot something. Maybe there's extra detail. Maybe the situation changes that you know how to react. Let's not make decisions under duress, because then what ends up happening is you then go talk to your buddy who has the wrong information, etc., and you make a decision for the wrong set of reasons. Again, Jay's Corner is not about to say, okay, well, I've got a crystal ball. It is about how to deal in practical terms for everybody. Now, back to temporary continuation of coverage. It's pretty clear, 31 days, you get it for zero. Okay. Then from there, you can see you can keep going, but you have to pay the full sticker price, the full premium. So FEHB has this ridiculously long menu of selections every year. It's like hundreds, literally hundreds. And basically what ends up happening is you are paying a lower price than the full premium. It gets revealed to you. My point here, and in many other locations, I've talked about whether or not you can qualify for this, which is, and once again, we're not beyond the scope of today. This is an estimator. This is an estimator. Let's say you're a 50-year-old male in Ann Arbor, and now you've been laid off, and for example, this is an estimate. You have to be very careful here, but that's why you can go to info@gh2benefits.com and ask me how to do this. But as a result, you can see here, this is lowering your cost. And now you can understand 22 minutes in. At the beginning, I said, look, I'm trying to ask you how much this stuff costs. Let's approach that so you can get a sense about your next job, how long you can wait. Can you afford it? Can you afford to retire? Maybe you already can, etc. So irrespective of age division, but the question of how much does it cost, that persists. If you go here and you have the temporary continuation of coverage, I'm telling persons here that you have time to decide, but we need to have specific details because from what I can ascertain, I've been told 50 different things because it seems to be from department to department that different rules are being implemented, being told. We need to get it from the horse's mouth. So that means we need to get it from your specific department. I will have a list of questions that needs to be answered as soon as possible. Sometimes there's a delay in getting the information from your department. Even from there, I'm going to say the following, which is that some people under FEHB have declined Part B. That is possible. But much like va.gov told you, right, in the same way, a similarity, and I'm not going to go back to OPM, but if you delay in Part B you're now 70, you've passed on Medicare Part B because you were covered by OPM, FEHB, you will have the late enrollment penalty. The things that I said 5 minutes ago about VA and your eligibility to enroll in Part B, that's a federal one. You still have this time over the next 2 weeks. Very, very important. It's very likely that I clip this segment and repost it for the Medicare site and the Medicare channel, which is that you can turn on Part B. You will, for every 12-month period, be subject to a 10% per year late enrollment penalty for Part B. So if that's 4 years, you'll pay whatever the base Medicare Part B times 40 plus 40%. That penalty is permanent, not a one-time penalty. So now the question is, now it's a math of money question. You've got to ask. I can show it to you. I'm not going to show you every single person. That's impossible. Person to person, situation to situation, location to location. I'm going to show you the example now. And this happened just this week. Under Medicare, this is the standard you can see a federal employee blue standard. Okay? And this is, generally speaking, high quality, meaning that there's no question about the fact that healthcare providers are going to be taking this plan. Okay, I'm not very concerned, to be candid with you. You'd be very hard for hospitals to not take the federal employee national plan. Very difficult. I'm not going to say 100%. Nothing's 100%. But the overall deductible, these are much lower than the market, right? This is much lower than the Affordable Care Act, otherwise known as Obamacare. Two words that mean the same thing. The issue is down here is that the out-of-pocket. So what ends up happening is you can see, and we're not going to, let's just call it, you have pre-existing condition, you have a health situation that you know you're going to need expensive health insurance health care coverage because you are a high cost user. You go to an oncologist. I hope this doesn't happen to you, but it does happen. That is different than Mr. Perfect. That is way different from Mr. Perfect here. So the issue, though, then is cost. And you can see I wrote this red myself in preparation here. That the question is cost here because this OPM plan, the premium is higher than Medicare plus Medigap plus Part D, and it's certainly higher than Medicare Advantage. And not a little less. It's, in other words, OPM, FEHB is far more expensive. To give you an idea, approximately $390 a person. And you can see the math. Medicare, $185, and you can. I will now show you the math here as far as comparison go. People gloss over it. It's a lot of money. If you're fit this criteria, for example, 185 is your Part B premium. Medigap, 125. Now we're at 310. Part D, 15, 320. The language of Medigap is far superior to this summary. Far. The network, if anything, is bigger under federal Medicare and plus Medigap. The cost is lower. This out-of-pocket maximum doesn't apply under Medigap at all. Your out-of-pocket maximum is the Part B deductible under Plan G, for example, and that's it. So what ends up happening is people don't do enough examination of stretching the rubber band when comparing financial stuff, right? Here, you have higher cost at OPM, FEHB, and worse coverage, both. The issue here is switching. Can I be wrong? The answer to that is yes, of course. Right? I've given you the base case. There are tons of exceptions. You have a spouse and minor children that you also need coverage, and their coverage can't be easily replaced on the Affordable Care Act at that price point. That's one, for example. Okay. And that one here can be more important. You could live in the most expensive location in the country where I'm wrong about this equation. That's also possible. It's not likely, but it's possible. New York State, for example, you got to squint real hard here. Why? Because your Medigap premium, if you're one of the few open enrollment states where you can get into Medigap at any point in time, you've got to squint really hard because these numbers will be close. And I'm going to tell you that Medicare plus Medigap plus Part D, if you live in New York State, is very likely to be more expensive than OPM. But again, you need to check your math. There's no shortcut here. And you can see I've already spent 20 minutes talking at this high speed about OPM and veterans. Their entire this has always been the case. This has always existed. It is simply that the headlines now have pushed it to the front of people's minds as you've got layoffs or reduction in force, I guess is the fancy people's way of putting it, reduction in force in certain locations. They stayed working beyond 65. The job gets eliminated. That person has to leave. They're worried about whether or not how the continuation of coverage works. The question, when that was maybe never even the case that they should have been there anyway. All of these things simultaneously can be true. In fact, they already existed here. And again, crazy people have written books about this. Please, this is everywhere. You know somebody who works for the federal government. And don't get me wrong, this at state and local government, especially at local governments, in the local municipalities, this has long been the case. City of Chicago. So what ends up happening is you cannot take a shortcut here in Math of Money because I'm trying to help people get to what? I'm trying to tell you this yellow. Uncertain about, tell me how much does it cost? You can see almost throughout the thread here on a wide variety of financial topics, and that includes analyzing different alternatives for people's savings and investment planning purposes. Is I'm trying to say, okay, how much does it cost? Then work backwards. Because my guidance, which is free on Medicare, for example, is going to be different from Mr. Perfect, who lives in New York, versus Miss Sick-a-Lot, who is the twin of Mr. Perfect, happens to live in Cleveland. They will get different guidance from me, almost certainly. And I've just made up these two instances. That's it for the first segment. Let's move on to, and the segue here is going to be about talking about how much it costs. Now you understand why all of the information is on savings and investment and where's the stock market, where are financial markets. And for those people who are new to the channel, be sure to like and subscribe to this video, please. I've talked at 30 minutes high speed. I haven't said like and subscribe, not even once. YouTube coach over here are like want to fire me like immediately, because I'm not good at marketing. It's just not. I'm not good at it. The tools are crazy, but I'm not a look at me person. To be candid with you, this is good. It's YouTube's world. I'm just living it. Anyway, here we go. So my point here is it tells you everything. If you have a very good handle on cost, you then can fill in the blanks about basically everything. Can I retire today? Do I have to keep working? If I jam down costs, can I take a lower paying job and still survive and still make it through a difficult patch, for example? Do I need to take a gig job? Can my gig jobs, or if I had 3 gig jobs, for example, I became an influencer. You don't hear me indicting, you don't hear me criticizing those as the path of kind of career advancement. I'm not a futurist. I'm pretty sure that it's not any news to anybody that the nature of employment is now permanently different. We are not going to have this situation where you're going to graduate from college, work for company number 1, and 40 years later, apply for Medicare, retire with your 401k. Before, by the way, I used to say pension. You're going to have 6 401ks. For those people, there are other priorities here, and I'm telling you what has happened here is along the how much it costs, these other priorities you may have in life. And now we are talking about millennial Gen X, for example. You're not a spring chicken, neither am I, right? There can be other financial priorities that you have. They come onto the radar. At the risk of a sounding like a broken record, stocks for show, bonds for dough. There's a reason this is, when it comes to savings and investments, your planning is to understand, then to solutions follow, right? Which is Not coincidentally, plan first, solutions follow. jo.com, that's this location here, which is my private website, jo.com. Right? Tells you how I see the pieces fitting. That when you have you now know what the cost of everything is, and in financial markets, that is interest rates. And in investment worlds, those are bonds. The price of everything is driven by the value of everything is on what something costs. And not surprisingly here, you will see this particular formula throughout, and the videographer should be fired, as I usually like to say, right? Unfortunately, I'm the videographer. So, if I had a person like working in the back to put up these graphics and stuff like that, then it would be fine. But I don't. So here it is. Right? This formula you can find everywhere. I'm talking about the denominator. All the glamour and glory goes to the numerator. The denominator is what you need to know first. And that is, again, this, I realize that I'm being repetitive to many, but like I said, the reason for the repetitiveness is because of the fact that this is, you go directly to, is Tesla a buy or a sell? That's what dominates the world. Instead, what I'm telling people is, look, we need to know how much stuff costs, and that is driven by interest rates. It's the bigger market. It's the more important market. There's more money involved in it by a lot. And now you can see what has happened and why so volatile. You've already seen, I'm sure, the headlines to say, okay, difficult market, and here it is. This is the year to date here of the S&P 500, minus 4% for the year. And if we go back, to give you an idea, I like to step back, not as predictive power, but just to give you a question about, was it worth the risk for here? Now the question becomes, okay, how reliant on financial holdings? If I go on YouTube right now, I get a bunch of different, look out for this. Don't worry about that. Look out for this. Don't worry about that. As if this is like an absolute thing. No. I refuse to believe that, because every person has a different set of all of the other things that I've talked about for 35 minutes. So what, we have the perfect portfolio of perfect market prediction to fit everybody? No, that's just not possible. That's why I stink at YouTube. I can't go viral because of the fact that what I'm saying is so obvious with common sense that I'm very sure that people can get. Now, you can see here. This is the year to date, and you can see, the technicians and stuff like that. This red line here is the 200-day moving average, which is a statistic. It's a summary statistic with all its good and bad. Statistics alone won't do it. We're going to get to that in a moment. But what I'm doing here rather is to look back for a year. And you'll see it right here. So this is here. This is the close. Now let's look backward. This is the end, this period where the lines intersect here, the purple. The purple plus sign there is the end of the Japanese yen carry issue. And here it was right here, down and recovered. My point here is we are no better than that point at all. If you had bought the S&P 500 right? Oh, thank goodness the yen carry problem is gone. And you just bought forever, you're flat. By flat meaning you've not lost money, you've not made money either. My point is the money in the bank during that period was 4% annualized savings account. You can see it everywhere. Just get in your car and go to an interstate. I promise you, savings account 4%. I promise. You will find that. My point is, you are worse off here in S&P 500 over this period of time. And by the way, what did not stop? Your bills. How much does it cost? We have come out of a period where people's rationale for equities, for stocks, has been there is nothing else. Tina, there is nothing else. So, okay, well, stocks went down. Okay, well, stocks in the long run, et cetera, just buy. That was true under two things. Actually, a long list of things. They all have to do with the interest rates, stuff with cost. Number one is Tina. Like I said, there is now something else, 4%. You already know this. Who else knows it? Everyone else. That means the actual people running the world's largest pension funds. They are scouring the globe now. They don't know about, they know about this. Yeah, of course they do. They know their stocks are no better on average, right? If they bought the market as a whole. You see people stretching, looking for returns. The large institutional investors, they're always, this is not for private people. I'm going to take my segue now. We've seen this about a bunch of up and down, and you can see here, this is the fastest decline here from the all-time high, like in history, right here. The speed. Jay's Corner is not about predicting a specific single fact. Right. I've told you principle about stocks for show, bonds for dough. I'm going to keep repeating that. Right. Stocks for show, bonds for dough on how much stuff costs. It is not the single fact of down. It is the fact that it's down and the fact that are you prepared to accept and understand that we're if I would tell you anything, what you have, and you saw this in other videos that I've posted here on the channel, this graphic here exists everywhere on prior editions of both the Substack as well as here on this channel. This blue bell here is now flatter and wider. The single piece of information that everybody wants to talk about is where we are right now. I'm focused on how volatile it might be because why? The combination of stuff happening to people is what can hurt you. And what I mean there, inflation, and you saw it in 2022, right? 2022, very difficult year in financial markets. Very difficult. You can see it from here, right? Oops. This is 2022 here. You saw what? Stock market down 20%. And many IRAs, 401ks down more than that. And at the same time, you had 8% inflation. So the cost of stuff increased and your balance went down. Let's say you were withdrawing from your IRA because you depended on the IRA to pay for stuff and how much stuff cost. The combination is what hurt you. And so now you're in this situation where you aren't back to 100 units. So What I've said here is that over here, this bar, this blue bell, the bell curve you see on the far right, is now almost certainly lower and wider. What is different? I'm going to talk about now what I saw on YouTube last night. The reason I'm in such a hurry today is because I woke up late. I woke up late because I was scrolling on YouTube. And I wasn't happy. Let's just go YouTube. And what you'll see here, and I'll get to it. There we go. Right, what you see here. Okay, so when I look here, I just, no. In isolation, almost no. Let's just take a look. If value investing always works, no, it doesn't.
I went to Bloomberg.
It doesn't. Why? I'll tell you why. Because if you just followed everything that I just said, right, that what you have now is you've got the 10-year note at 4%, 4.31%. I can get this for 100% certainty. Not a bond fund. It's different than a bond. For example, a 5-year CD, 5-year jumbo CD. There's a guy in TikTok called dividend stocks. I'm just like, wait, what? There's a big difference here. And what's that? Jay's Rib Shack has no legal obligation to pay a dividend. Doesn't. And oh yeah, by the way, value investing it usually means, right? So now you can see that even here, PhD. I'm not saying this person's undereducated. I'm just saying this person hasn't been on the playing field of financial markets on a global level. I've lived on 3 continents on the matter. And this is the shallow end of the pool. My point here is now there's something different. And your alternative to the past, there's no always why interest rates are way higher than they were here. The reason that dividends have worked is because there was nothing else, because your comparison was 0.54%. Today it's 4.3%. I've got nothing against General Mills. I've eaten tons of boxes of Cheerios. Nothing obligates General Mills to paying the dividend, which is at a lower percent, I'm quite sure, than 4.3. So the idea that somebody, and I haven't even watched this video. I'm sure this label's not, I don't agree. Value investing always works, huh? Okay. That means tons of Jay's Rib Shack. Small companies. No better for 5 years. 2021. Sorry, 4 years. January 2021 to now, 0 is your return. So now you have a risky dividend, right? Because Jay's Rib Shack has no obligation. My costs are higher to my business. I don't know who my employees are. They told me they have a green card. I'm not sure. I'm subject to tariffs because my inputs, because I buy exotic pork imported from from Canada, and now I'm getting hit. Stuff costs more. And now you can see, I didn't even scroll even a little to find something fundamentally wrong here on YouTube. And again, I don't know this person from Adam. I'm sure he's better educated than I, PhD, right? I only have an MBA. Right. My sister has PhD. She sometimes, I try to tell her something, she swats me down. She laughs me, okay, you undereducated. I deserve it. Sibling rivalry aside. that my point here is that you need to be careful here when you're watching these videos. Like this always stuff, it's like always. Yeah, always was true when interest rates are down over here. Always isn't true when stuff costs companies more. And oh yeah, by the way, if you're the saver, you can get more. If you go on other videos in this channel, you will see savers win. Why? Because you've been waiting for this to not accept the risk and get this higher return in a situation where what? Where we have gone nowhere. Your stock investment has gone nowhere, for example, as a whole, throughout during this period, during which time you have clipped coupons, right? You've gotten interest payments at this rate. You can see it during that same time frame. 4.34, we've gone nowhere. Yeah, you've gotten this 4% in cash with 100% certainty. If it was a CD, for example, that was a jumbo, maybe it was even FDIC guaranteed, which I don't think really is an extra layer of stuff. That's a different topic. That's a different video. Your money good. I'm not disputing that. But you can see why I'm being this animated now. Because it took me 1 second to find something wrong here. It's wrong in isolation. It's wrong in combination. This is everywhere. My point here is when combinations go wrong to people, right? In other words, now you went, oh, it's never going down. By the way, right here, this date, February, somewhere in this time frame right here. This is the highest purchase right here where my the purple plus is. Right in this area is the highest inflow from retail investors into this security ever. Right up here. I'm not kidding you. Right, which is right in this, and during this period, I put my tongue firmly in cheek. And I sent a text to a client. I said, when you see this headline, you go the other way. In the absence of a crystal ball. Why? Because the information given to retail investors on how financial markets work, act in reality, how professionals work, how the asset allocator, CalPERS, CalSTRS, Norway Oil Fund, Government Investment Corporation of Singapore, that looks nothing like what you see on, oh, Tesla's a buy at 200, target price of 550. It has these, it will look and sound like entirely different languages. And oh, by the way, I've given insight on this on where is this? I'll put a post, which on how the portfolio. Oh, Invest Smarter. Here we go. This is my video with Ann Lester, who is a pioneer here of targeted date funds.
Welcome to Jay's Corner.
So, and you can see it here.
I guess the other very humbling thing.
This is just between myself and she's one of the pioneers creating targeted date funds from inception, which sits in the majority of 401k plans at the largest companies. How it works, how these videos here is so different that for people to piece it together is just not likely. And also the idea of simple oversimplified tenets, oversimplified principles, right? Always works. What's another one? It's not timing the market, it's time in the market. Also, one of my favorite ones to say why it's wrong, and here is why here. It is this thing of sequence risk. And this is like I said, we've already talked about, welcome to We've Already Talked About This channel. Is what has happened even since 2022, right? Your balances went down, inflation at 10%, you had to withdraw. So, and what you will see, I promise you somewhere on YouTube today, I promise you this is going to say, is you hold because you'll miss the up. Yeah, I with 100%, 99.5% certainty, it will not take you very long to hear this. Wish I could type. What happens, I've got my microphone here, so I'm usually actually an excellent typer. But my point here is that you hold because you'll miss the upside. And the upside, when people report this to you, it's going to be in percentage terms. And over here, this is telling you, and I tell this in my tongue-in-cheek way. That's my, that's why I'm annoying. Or I try to say it's my charm. You don't take summary statistics and redeem them for groceries. You don't. And you can see it here. What this is saying is both columns here have the same average return, but at the end, one is 20 units higher than the other. Same averages. And this is sequence risk. And this is the nice part. This is the easy one of sequence risk. This is just the simple mathematics of how summary statistics, average return, average percentage return, average annual return. This is the key one here, because it's trying to make a complicated matter oversimplified, which is why Occam's razor doesn't work. Another entry on Jay's corner. Which is that when you have this, this presumes you didn't need to use any of the money for withdrawal. So you can see what happened during COVID. I have to stay at home. My adult child is ill. My adult child needed some emergency funds because they lost their job. So now you pulled from your retirement savings, which were down at 85. In other words, from 100 to 85. So now you pulled out 5 and now you're at 80. You don't get to 100. Hold because you'll miss the up. Doesn't make sense. And the reason is, and this is what that is, and I'm just going to, we're almost done. That is the language who don't understand what modern portfolio theory is and how it works, how CalPERS and the largest pools of money actually work, of which I've discussed here with Anne, right? And how. Anne, by the way, is one of my colleagues at protectedincome.org, the Alliance for Lifetime Income, which is where she's an education fellow as well. She's from the bond market as well, stocks for show, bonds for dough. Is that we are part of this nonprofit to talk about the function of annuities in an overall plan aimed at the public and advisors. I'm going to finish on that in just a very important thing because of an advertisement that I've seen, and you've seen it too. My point here is this is Mr. X timeline, right? And my point here is that when you say, okay, we just buy and hold forever, yeah, that's easy to say, but guess what? You need to redeem your money because of why? Expenses. Food. Your cable bill. Do people use cable ever? Your mobile phone bill. Electricity, right? You need to have money to do this. My point here is when you couple this sequence risk and all of these extra points that I've talked about here today on the channel, thank you so much, right? Which is that Be sure to like and subscribe. That's twice, which is a huge improvement. But anyway, you can see there's nothing to say that you're right with 100% certainty. Right? If that were true, you don't need a diversified portfolio. I remind you. There's a reason that these things show up. One of these branches is you're right. One of these branches you're wrong. If you're wrong at the wrong time and you subject yourself to all of these other matters that I've talked about here, right? I don't say that we have a retirement crisis, but you can create a retirement crisis for yourself. I'm trying to help you avoid it and not stick to like something that was not correct at the beginning. Not correct at the beginning, for example, right? It wasn't correct at the beginning. It's not correct in isolation. It's certainly not correct in this combination. And guess what? This is you having to deal with this. You want to take risk, eyes wide open. If you can afford, no problem. You get 100%. Some of you have to take the risk. I get it. Some of you don't take the risk because you're not supposed to be taking the risk and you don't need to. You've got other fish to fry. You have better things to do. Like surf Jay's Corner, jo.substack.com, But anyway, my point here is that you can see why actually, candidly, why I keep talking and keep creating videos and material. And, I thought that I was going to end at 40 minutes today, but I'm wrong. Because these topics tie together. And I don't like to hear when misinformation comes out to the world and now someone cherry picks a single line item wrongly and then holds on to something out of oversimplifying things that they should never have done. They shouldn't have oversimplified anyway to start, right? I've talked about this in the past, other locations here on Jay's Corner, right? Is that you've got all of these other things here that, and if you look at this archive, what you'll see is one of these is, I wish they had the thumbnail, one of them is the Occam's razor is wrong. When you oversimplify it because you wanted to get it in a 10-minute video, you don't get it. You don't get the complete story. You don't get how it affects you here. This is what I care about. Right? I care about us. And in your house, that means taking care of this. All this other stuff, right? I can eat. It feels terrible to sell at the low. Guess what? 100% rational. Depending on your situation, it can be. You need to ignore these like overarching ideas that look right, totally wrong. The problem here is I realize that there's wrongdoing. I do. I understand that in the financial guidance industry that certain things go wrong. I'm not saying, here's an example. So have told the stable, which is my audience of comprehensive financial clients, that this thing here is a security that should not exist in private people's portfolios ever. I very rarely say ever. You can't price them. If the client calls the broker, the brokerage, the asset manager, I've got my statement, it says 106. Can I sell it at 106? The answer is no. I'm telling you this, and some people know this. I've been on the ground floor of creating these for large investors, not, right? You make soup, we make soup. We didn't tell the buyer that they had to buy or sell it. Our job is to make soup. And in the same way, this is what insurance, every financial product, right? This is why, by the way, The Big Short is wrong, the book, right? This is not as one-sided as Michael Lewis' point. He's a famous author. My point here, that I digress, which is that this security should not exist. And the reason is because you don't know what the actual number is here. Because the statement number, the number that says on the statement is not the number that you can turn into cash. I tell persons, I've seen this in a portfolio that I've seen firsthand. And I told that person, not wanting to stick my nose too much in the beeswax, just ask the broker, how is this stuff made? Tell me with detail, how much is this? How did you make this stuff that you put into my account? How is it made? And why I said that is you can see throughout all of this stuff here, three-legged stool, insurance defined, forward rate. Forward rate's a good one. I need to know how the soup is made, the minestrone soup. The idea of replication. And that literal, in replication, do we have it here? We've got so many topics. You can see all the dirt. There are 50 tabs now down here, for example. That what you have here is me explaining to you that I know how to make the minestrone soup and giving you the different components. And I'm telling you here, there's no chance that the broker understands how this soup is made. No way. And if that's the case, what's it doing in the statement? So I'm not going to tell you that wrongdoing doesn't happen. That said, it is also the other, you can see it here. Somewhere on your Facebook, somewhere in your email, there's going to be this banner. And it's going to say something by Ken Fisher and Fisher Investments. We're different. You're not different. You charge more when your clients' balances are higher. That's the way the entire business works. You're not different. The flip side is here. Why do Fisher Investment? Our founder, Ken Fisher, is fond of saying I hate annuities because he believes that anything you can do with annuity can be done better with other investment vehicles. He believes, and he's wrong. As an individual investor, let me just be very, very clear. Some brokers, some advisors, some financial people say this because they don't know any better. It's true. Some people in financial markets say this even though they know it's not true. That person, I'm not going to call that person a liar. That person is talking as if he is a liar. That's you. You can't make the replicating portfolio of an annuity if you are sitting with $300,000 of retirement savings. You can't. Somewhere on the corner, we don't have time today. We're at the end. Somewhere in this channel, on this channel here on Jay's Corner on YouTube, be sure to like and subscribe, is an explanation, a deep dive in annuities. I showed you how the minestrone soup is made. Your broker can't do it. You need, for $300,000, no, there's no chance that you can create a guaranteed lifetime income stream in the way that a fixed indexed annuity can do. You can't. The broker doesn't know what's inside of the soup, so how can they manage it? The size is too small, you can't do it. Right? You don't get to make a cup of minestrone soup. The costs are too high. So the idea that you can do with an annuity can be done with other investment vehicles. That is true if you have 10 million. If you had a chef who understood how the soup is made. And oh, by the way, they put down their other work because that chef has got to pay attention to the soup all the time. Especially when markets move around like this. They've got to pay attention. You don't get to just like turn the soup on to boil, and then what happens when, the bottom of the pot starts to get a little crusty and smelly, right? You've got to stir this soup. Kind of like that soup analogy, right? My point here, this here, it's an example. So yeah, there are these banners that says this like ad, beware of annuities. Beware of persons who think that they're trying to, who are, you can see here. This is like the worst kind. Because it's the line that this does not cross is never can he say he guarantees. Never. I defy you to find me. I'll tell you this. I'll tell you this. If you can find me the quote where this person says, and Fisher's Investments says, that he guarantees anything you can do with the annuity can be done with other investment vehicles, I will send you $1,000. But you have to use the word guarantees. And that's my point. I thought you said X, but he really meant Y. And the reality is the difference between X and Y, some financial people don't know the difference. That's not this person's excuse. Fact. My name's J.O. I'm the author of Maximize Your Medicare. This is Jay's Corner. Be sure to like, subscribe, share it with other people. If you have questions, private, personal ones, you're confidentially, of course, always info@gh2benefits.com. I'm off the soapbox. It's time to see how long my bracket will last. Have a great Sunday, everybody.